Good morning. Thank you for joining us today for our next installment in the Startup Fundamentals Workshop Series. My name is Ala McCoy. I am Director of Startup Support at the University of Maryland's UM Ventures. This series is presented by UM Ventures in partnership with Maryland Technology Enterprise Institute at the Clark School of Business and Dingman Center for Entrepreneurship at the Smith School of Business. Our today's topic is essential tax issues for startups, which is a very important topic. Not many people like to discuss it, but many people are concerned about it. And I am very happy to welcome today's speaker. Please welcome Samuel Handwerger. He is a CPA and holds MS in taxation. He's a TERP. He graduated from the University of Maryland Smith School of Business with a degree in accounting. And then received his master's degree in taxation from the University of Baltimore. I will let him speak more about his background. He has a very interesting background, very rich background. He knows a lot about tax issues for small businesses. So thank you so much, Sam. Why don't you go ahead and take it from here? And again, as a reminder to everybody, please feel free to submit your questions at the bottom of your screen using the Q&A function, and I will be monitoring as we go. So thank you so much, Sam, and the floor is yours.
Thank you very much, Ala, and good morning, everybody. It's always great to be talking to a bunch of budding entrepreneurs, because the definition of entrepreneur that I learned through 35 years of public accounting practice is an entrepreneur is the eternal optimist. And so I'm always happy to be talking to optimistic people. As a way of a quick lesson, I'll give you an interesting fact about my background, and the lesson will be how to sell yourself, because entrepreneurs are we're always constantly selling ourselves, and particularly entrepreneurs, we're selling ourselves and our services and our products and our innovation. So here's a lesson in how to sell yourself. It's not what you say exactly, it's how you say it. In my CV, amongst other things, is the fact that I was an expert witness on a landmark tax case in Maryland. You can look it up if you want. I'll send you the link. It goes back 20, 25 years. And it indeed is a landmark tax case. It's been cited hundreds of times. And that's what I say in my CV. Expert witness on this case. What I don't say is I was on the losing side. So it's how you say it. At this point, nobody would go back to look. They would just say, oh, wow. All right. We have a very interesting topic, which is extremely dense in terms of the amount of material. We'll only be able to scratch the surfaces, as it were, but I'm going to try to scratch the surface in areas that I think will have the most interest of you to at least be knowledgeable enough to know what you need to ask a CPA or tax lawyer when you go to get started. And I'm going to now go to share screen, and that way you're going to be able to see my slides. And it says host did not disable participant screen sharing. So we'll ask Ala to see if she can fix that up.
It just fixed it. I made you a co-host.
Okay, great.
Sorry about
All
that.
right, very good. Okay, I need 1 second here. So I'm going to go back to stop share. I just need 1 second to set one thing up because it died in waiting, if you know what I mean. One of those things that needed to be kept constantly refreshed. So pardon me for that. And away we go. All right, now back to the job at hand, which would be, and here we go. All right, we are going to talk about entity choice. That's the first topic, which will take up about half of the webinar today. And the concept of entity choice is, what type of entity do you want to be for tax purposes? What are the advantages and disadvantages? The agenda would look like this. These are our choices: corporation, partnership, which we could also define as limited liability company. That's the other part of the definition. It's the same thing for tax purposes. LLC, you've probably heard about it. And then you have S corporation, which is the same thing under state charter as a corporation, but it has a special tax status. There's sole proprietorship. And we have, last but not least, tax exempt organizations, which we won't really discuss because it's a nonprofit and it's not generally a choice that entrepreneurs will make, since your profit taking from the enterprise is limited. under the tax law. However, sometimes you might be, and this is all we'll say about it, sometimes you may be in a situation where your particular goal, your particular mission in your entrepreneurial life demands fundraising of a nature of, quote, charitable, philanthropic people to help you raise the capital for that particular type of venture. It may be of something that's of a public good that's just not destined to be profitable to the nth degree that attracts investors. So here, the tax-exempt organization is a way to raise capital vis-a-vis the charitable deduction, people who are inclined to help good public causes. And an occasional entrepreneur comes my way where that's the particular entity of choice. All right, so what do we got here? We have these choices that we're going to learn about, and we're going to move on first just to get some key terms under our belts. So when we talk about it, we'll have an idea of the definitions. First is what we call a flow or pass-through income entity. This basically means that the entity does not pay tax. So that's what this is all about. Entity is not a tax-paying entity, which sounds good, but what happens is its income passes through to the owner. The reason this structure is beneficial is because it's not subject to double taxation, which is tax-paying entities are subject to double taxation. Once at the entity level and twice upon distribution, the second time upon distribution to shareholders and partners. And we're going to demonstrate by a little diagram here. Let's take the entity that is taxed. Of all the entities you saw on the agenda screen, C corporations are the only entities that are taxed entities. All the others are not. And the C corporation will pay tax at its level. So we'll pay a tax. And then upon paying dividends to the owners and shareholders, there'll be a second tax, and we'll call that a dividend tax. Now you might say, well, that sounds pretty bad. And it used to be pretty bad until the corporation rates at the C corporation level dropped to 21% from its historical 35%, which lasted a long time. And the dividend tax are at 20%. So you put those two together and you're looking at about a 40% tax rate. When the individual tax rate is at 37%, you can see now that the C corporation has some degree of, maybe it's an interesting way to do business, particularly if you're not paying dividends right away. If you don't pay dividends right away, then your only tax at the moment is the one level of tax at the C corporation to 21%. And as a result, you're deferring the other 20% tax till when dividends are paid, which could be many years from now. Particularly with a startup company, you figure you're going to be reinvesting for maybe a number of years. Your investors aren't expecting to be paid back or to receive dividends for a while. It takes a what if scenario, plot it out, and let's see what it all means. And that's part of the game that we play when we decide which kind of tax entity to be. So this flow through or pass through entity does not pay tax. It passes the income to the partners or shareholders. So if we have this entity and it's zero tax, and this is a pass-through entity, not a C corporation, but it passes through, pardon this rather crude diagram of the shareholders, and they pay as much as 37% as the income's made, regardless of whether dividends are paid, regardless of whether there's distributions, they pay the tax at this rate at the time that the income is made. So there may be an interest in doing a C corporation where that second level of tax is deferred for a long period of time. Nevertheless, if you have income and you have the cash, then you may be saying to yourselves, gee, passing the income through to the partners is not so bad because the cash will be there in the form of distributions to help pay the tax and yield the profit that everybody was thinking. If I've lost you already, don't worry. That's a good sign. That's a good sign that you're paying attention. It's not so simple. I'm going to try to break it down as we go further. So let's hold your judgment as to your cognition at this point. Let's see how we go. The pass-through entity, as we just shown in the diagram, passes the income to the individual such that they're taxed on their personal tax returns in the year the profits are made. In the year profits are made. And that's a key to the pass-through entity. They are quite popular. So you might say, well, gee, why are they quite popular? And that's because the corporation rate for those C corporations just dropped a few years ago. And secondly, there's some still issues with C corporations. The pass-through entities usually potentially yield what we call self-employment income, which is going to be paid regardless. If you're an entrepreneur, let's talk about this for a second. Let's talk about it this way. If you're an entrepreneur, good old entrepreneur, we'll put that this way, and you're going to wind up having income, hopefully, you're going to have an income tax based on your net profits, based on your net profits. It's always the net after expenses. What are expenses? That's the second half of our lecture today. You'll have an income tax. The other tax you're going to have, which is not based on the net, but based on your earnings, we'll call it an earnings tax, but specifically it is Social Security, and we'll label this as SE, Social Security and Medicare. This rate is 15.3% combined. If you're an employee, you only pay a half and the employer pays the other half. But you hopefully are going to be entrepreneurs. You're going to pay both halves. You might say, well, that doesn't sound fair. Who said life is fair? Who said income tax is fair? But those are the two taxes that you're going to be concerned about. And the earnings tax certainly is based on your earnings. So if you don't have any earnings at the end of the day, you don't have this 15.3 Social Security Medicare tax to worry about. But hopefully someday soon you'll have the earnings and you'll pay the tax on that. Those are the two taxes that we're concerned about. And there it is. The SC tax is composed of these two portions. The two portions, if you're an employee, you pay half of the 15.3, the employer pays the other half. Entrepreneurs are their own boss, so they pay both on their earnings. If you have employees, you pay half of their earnings, what you pay them in salary, and they pay the other half. What you keep for yourself is where you pay the two portions, because that you've kept for yourself as if you paid it to yourself. Complicating the decision between the different types of entities we have is what's called a qualified business income deduction. This really complicates what used to be a fairly straightforward decision as to what startup should be. Let's illustrate a bit more of the details. We have these C corporations which are tax paying. They have two levels of tax. So we'll say two levels. You have the pass-through entities, which we can now define as being S Corp and limited liability companies. These pass-throughs do not pay tax. The individual owners pay the tax as it is earned, regardless of distribution. They pay the tax. And on the right-hand side, you might say, well, okay, so there's only one level of tax, whereas there's two levels of tax on the left-hand side. And that's true. The issue, though, is that with the S corporation, traditionally, we used to be able to avoid a lot of the SC tax, the 15.3%. There was a legal loophole, it still exists. Actually, President Biden's tax return revealed that he takes advantage of the legal loophole. And what that is that the S corporation pays a fairly low salary, as low as we can justify it under tax law. And that low salary is the only thing taxed at the 15.3% level. Therefore, you pass a lot of income without having to pay the Social Security Medicare. The problem with that is that the new qualified business income deduction is based on salaries paid. So now the gimmick is you have to weigh out what the prospective income looks like. You have to do like a budget, take a look at what the future looks like in terms of net income that'll be earned by the company, and compare the Social Security tax to the qualified business income tax, because this reduces the income tax, as it is a tax deduction. It's a phantom tax deduction, but an important one. The idea of the qualified business income tax deduction is to create some type of parity between the low 21% C Corp rate and the higher individual rate at 37%. With the qualified business income tax deduction, the QBI, you can get down into the 28% range or lower, or a little higher, depending on your particular tax bracket. And you can see that Now you're at least getting a little bit better parity. Don't forget, over here, you still have a 20% tax to pay when the dividends are paid. So there's still a lot of interest in being on this side of the fence, which is the pass-through entity side. We'll call it pass-through entity, PTE. And that means that, generally speaking, to draw some conclusion at this point, generally speaking, your probable best start as an entity for tax purposes is to be a limited liability company. And I say that for just not tax reasons. I say that for another one, which is that it has legal liability protection, like the name says, limited liability company. So this legal liability protection, similar to a corporation, is a way of protecting your personal assets, your personal income from other sources, and future income in the event that the particular entrepreneurship venture that you start out in doesn't succeed very well and you have debtors that you're beholden to. We won't go deep into that other than to say that this is a good way to start in a legal liability protected entity so that you're, just in case, let's put it that way. We won't hope for it, but just in case. This is opposed to a sole proprietorship, which probably we're not going to recommend. Sole proprietorship means that all of your assets are subject to risk. There's no legal liability protection. And therefore, it's probably not the best place to start a business. Maybe if you're just testing the waters for a couple months and going to see whether this thing's going to take off, because it's the cheapest, it's the easiest way to get started, maybe then you do it. But once you're starting to deal with the public in a meaningful way, this is not going to be a place you want to be. You want to be back to a limited liability company at a minimum. So this would probably get my stars or asterisk as the entity of choice for, say, a small business venture that you're starting with the hopes that it'll take off. You can attract investors with a limited liability company. That's not a problem. You can be really large in terms of assets and investors with a limited liability company. It will pass through the income to your owners, your investors, if they're owners, because it's a PTE, it's a pass-through entity. So that's a consideration when you're attracting investors. They're going to want to know that you at least will be able to distribute to them enough to pay the tax that they might have to pay year by year. So they would want to know that there's at least enough cash to pay the tax on a yearly basis. Back to that qualified business income deduction, which I mentioned, which is an incentive to be a pass-through entity where you have salaries. So if the pass-through entity has significant salaries, either to yourself or to others, then the qualified business income deduction means that the overall level of tax to the owners, the investors, is going to be a little bit lower than it otherwise might be. Instead of being that 37% rate, which is the highest individual rate, as I said, it can come down to 28. Let's put 28, 29, somewhere in that range. And that's a big incentive for saying that the pass-through entity is still probably the best place to start. Now, you could start as an S corporation. That will get into whether you would have to then do a what if. You would probably need an accountant to help you do the what if. An S corporation is going to be a tax savings type of vehicle as opposed to a limited liability company. It's because of the qualified business income deduction being pegged to salaries that come from an S corporation to their owners, as opposed to limited liability companies where there are no salaries. And let's go through that in a little bit more detail. That's an important point to make a distinction between S corporations and limited liability companies. So let's take a little pause here and go through just a very conceptually important difference between the two. They are both, here, let's take that breath, okay? A little breath before we dive into this. They are both pass-through entities. So they do not pay tax. That's good. They pass their income to the owners, investors who pay the tax. Okay, not bad, but it's only one level of tax. That's very nice. The LLCs, to the owners, there's no salaries to the owners. You do not pay a salary to the owner. You pay distributions. You can pay distributions any way that you would like to the owners and to yourself, as your agreement allows you to do. If you have other owners, you pay distributions. It's not a salary. It doesn't get taxed as it comes out. as it comes out. You pay tax on the income that it's earned and calculate it, but you don't pay a particular tax when you make a distribution. Opposed to that is under an S corporation, owners do get a salary, and that salary is going to be subject to that SE tax. So that if you can pass out of the S corporation distributions that are not called salaries, and it's whatever you call it, if you can pass out distributions to the owners of S corporations in huge dollar amounts and keep the salary very low, let's do it in a sort of a low color, then your SE tax will be a lot lower in the S corporation compared to the limited liability company. The problem is that the QBI deduction could be higher with the LLC, and the S corporation QBI deduction may be very low, and at that point, the difference between the two can get wiped out such that the limited liability company could be tax favorable. Since the QBI is fairly complex, the only thing I can tell you, unlike a couple of years ago before they created this QBI, is that you need to do the numbers. You're going to need an accountant to sit down and plot out based on your budget which one of these two pass-through entities works the best. Other considerations should come into play, which would be the following, and this is the last one I'll go through, but it's an important one. One more consideration in the difference between S corps and limited liability companies, and this is very important, and it's a tax-oriented one. When it comes to S corps, paying the distributions, which are tax favorable, as you can see. Why? Let's back up. Why are distributions tax favorable? So we'll put a smiley face there. Why? Because they're not subject to the SE tax, whereas potentially, most likely, distributions on the LE side are going to be subject to the SE tax. And so we would put a little not so happy face on the LLC side. The QBI deduction on the LLC side, the limited liability company, could make up for it. That's why an accountant's going to need to do the what if between the two. Here's the point, because we already went through those tax calculations or calculations that'll need to be done. But here's the final point. With S corporations, in order to make distributions, they have to be made equal to the percentage shares of the owners. So if you have X, Y, and Z, whatever their ownership is, those distributions, meaning outside of salary, have to be exactly pegged to their ownership percentage. So if you have a 20% owner, a 40% owner, and another 40% owner, you got to do distributions in that percentage to each one of those owners, 20, 40, and 40. You're locked in. In order to stay S corporation, you have to do that. Whereas on the LLC side, limited liability company side, you can have X, Y, and Z, and your ownerships could be the same, 20, 40, and 40. But in any given year, you don't have to make the distribution pro rata. That's a good accounting word. You don't have to make the distribution pro rata. You can do whatever you want. Now, you would have to have an agreement with your owners as to what they're going to get, but it works really great if some owners are performing well one year and they deserve more, you can give them more, whereas the other owners can take less. There's no requirement that it has to be done pro rata. At this point, I think that you can see that the entity choice is not so simple, and that's why you're going to need an accountant to start, but at least you go in with some knowledge of what the issues are. What are you looking at? Pass-through entity versus double taxed entity. For that QBI deduction, by the way, just so you'll know, where it comes into a situation where it may not apply at all, because QBI deductions do not apply when the income is over $300 or so thousand. I'll say greater than 300, just it's a little bit, that's not exact, but you get the idea. When your income goes above a certain level, these particular entities, or I should say not entities, these particular professions do not qualify for the QBI. So it doesn't even become an issue. So if you're in one of these areas, then the issue of what kind of entity to start with is probably looking like this. Let me give you the demonstration. Let's just take a look at those entities or these business industries where the QBI deduction doesn't apply for a second, and say to yourself, okay, I expect to make significant money, a couple $100,000 a year or more, and I'm going to be in the healthcare field, or I'm a consultant, or in athletics, financial services. You're in one of these areas. In that case, when you are making the bigger bucks in the six-figure range, what you would then be able to say to yourself is that, the entity of choice becomes easier. Now I'm looking at S corporation without any QBI issues, and an S corporation may be a perfectly good tax entity to become at that level. Prior to this level, it's a toss-up. You're going to need some accounting help to decide. But between the two, once you get above it and you're in this area of industry, I think the S Corp becomes the way to go. The good news about how you go about making all this decision is the following. If you start out as a limited liability company, and this is one of the great things of tax law today, one of the best things that they've done is they've made the issue of what type of entity you are a check the box matter. So there's a form where you basically check the box and say, this is the tax entity I want to be. So if you start out as a limited liability company, which is the easiest thing to start with legally, and then you decide I want to be an S corporation, you merely check the appropriate box, and now poof, like magic, for tax purposes, you're an S corporation. It's very interesting. Legally, you're still a limited liability company, but for tax purposes, you're an S corporation, and you got all the benefits that an S corporation might have for you in terms of taxation. So that's basically the types of concerns you want to be able to raise when you, I suppose, the way to take this part of the webinar is that when you sit down with an accountant, you'll know you're sitting down with the right one if they're discussing these issues with you the way we've discussed today. If they don't seem to know these types of considerations that have to be made when you're making the decision, maybe it's not the best place. Maybe you need something different. All right, we'll probably sum up a little bit through the next few slides. So if you've missed anything, hold on to your hats. Corporations, we have C corporations or S corporations. When you form a corporation in a state, you have two choices. To be a C corporation, you don't have to do anything. That's the default category. You're automatically a C corporation. Or you can check the appropriate box and say, I want to be an S corporation. That would take you out of being, quote unquote, and you should say this along with me now, that would take you out of being doubly taxed or a tax-paying entity. C corporations are tax-paying entity. And let's see if you can fill in the blank. That would take you to not being a tax-paying entity, but to be, hopefully I don't hear it, but I can hear in the hallways of Tidings Hall, people screaming, pass-through entity. And that's exactly right. That's what checking the box to be an S corporation would be if you form yourself as a corporation. You'd be a pass-through entity, avoiding the double tax. So that's the C corporation. Corporate tax rate was cut from 35 to 21, as we said, making it an interesting vehicle. The vehicle of the C corporation is it does allow you to become a public company. If that's in your near future, then you might just want to start off that way and leave it alone. On the other hand, if that's down the line, you can always change to be a C corporation because you can uncheck the box later on and go back to being a C corporation. That's the beauty of check the box. All right, that's C corporation. We'll skip this slide for the moment because it's in the interest of time. Then you have the S corporations, which is those pass-through entities. You have limited liability companies, which are also pass-through entities. These, by the way, I would say are best for real estate. If we can draw some conclusions today to help you, if you're in the real estate business, limited liability companies, that's where it's at. S corporations, nah. For many reasons that are tax reasons that go beyond the scope of our webinar, let's make it easy and just say real estate, that's a limited liability company, no questions about it. S corporation, definitely not. C corporation, no, definitely not. If the LLC has only one owner, which is allowed. In the state of Maryland, you can create a limited liability company all by yourself. You don't have to have any other owners. But then there becomes a new wrinkle, and that is for tax purposes. Isn't this fun? This has been my life. For tax purposes, it's a disregarded entity. This brings up a fascinating topic in tax law, which is that you have an entity. It's a legal entity. It's a limited liability company, but you're the only owner. And for tax purposes, the tax law says it doesn't exist. And therefore, you are going to be taxed as a sole proprietor. You're not a sole proprietor from the liability side, so you don't have to worry about your assets because you are a limited liability company. But for tax purposes, you're going to be taxed as if you were a sole proprietor. Now, if you don't like that, and there might be reasons not to like to be taxed as a sole proprietor, and your only choice is to check the box and to become an S corporation. So you can take a limited liability company, check the box, and be an S corporation. That decision should not be made lightly just because you don't want to be a sole proprietor. You should consult with a CPA for sure. One little trick, though, I'm going to tell you a trick that won't cost you the $300 or $400 that it usually costs my clients. And that is, you can make a limited liability company for tax purposes where there's only one owner. You can make it to become not a disregarded entity. So let's go back to this slide. The one owner is a disregarded entity. Suppose you don't like that. Here's how you do it. So you take an LLC and you make somebody else a 0.1% owner. So you'll own 99.9. That'll be you. And somebody else owns 0.1%. And in your agreement, you can protect yourself so that the 0.1% owner can't do anything to harm you. You can have an agreement that just ties that up. And now you get taxed as a partnership. So PTR, you get taxed as a partnership, which is no different than the LLC pass-through entity that we've been talking about. It's just a term of art. You're still getting taxes in an LLC, and you don't file as a sole proprietor. Little trick. Why would you want to do that? Well, there used to be some theory that filing as a sole proprietor has a greater audit risk. Nobody knows for sure. This is sort of a play this game when you get there. Reporting requirements. Let's go to those so we can get to business deductions. In all these entities, even a sole proprietor has to file an income tax return. All of them are calendar year except C corporations. So if you are an LLC or S corporation, your year end is December 31. C corporations can choose any year end they want at the end of the month. So you got a choice of 12 months to choose. You could be June 30th if you're in the government contracting business, so you can match up to the government's fiscal year. You could be August 31st if you're a school, so you can match up to the natural business cycle. So C corporations can choose any year. Does it make a difference in any way? Not really. So it's just a term of art to let you know for filing purposes what your choices are going to be. All these entities will have potentially payroll reporting requirements where you're going to pay payroll tax on wages paid to employees, to bona fide employees. With the S corporation, the owner can also be a bona fide employee. You may have picked that up in the discussion we had just a little while ago. An owner can be an employee with a LLC, otherwise known as partnership for tax purposes. In an LLC, the owner is not paid a salary, so the owner does not become an employee. That's another requirement, is payroll reporting. So if you're having salaries either to yourself under S corporation or salaries to others under either S corporation or limited liability company, you're going to have to pay payroll taxes, and you'll have payroll reporting to do. It's what we call the payroll tax burden. If it's paying to somebody who's not you, it's 7.65% for that SE tax. That's half of the SE tax, and plus workers' compensation, plus unemployment insurance. We'll call that, we'll just do unemployment insurance, which is required by the state. Workers' comp is required by the state, plus. And so the payroll tax burden, I wouldn't be surprised, even in a startup business, if paying salaries to somebody got you up to around owe 12 to 15% on the dollar for every dollar you pay to an employee, I wouldn't be surprised if that's what happened. So you need to take that in consideration when you're setting salaries. If you set a salary of $100,000, it's could cost you another 10 to 15 on top of that, with required payroll tax requirements under the state that you live in. You also may want to offer retirement plans or other fringe benefits, and that could just up the ante of what you pay for the burden of a dollar salary to 20% easily with those benefits. Planning point to be, you're planning to pay $100,000 to an employee, it's going to cost you 115 to 120. Just take that into your budget. Independent contractors avoid the payroll tax burden. Yay! So why not just hire everybody as an independent contractor? You know what? You work for me. I'm not going to classify you as an employee. Nah, we'll classify you as an independent contractor. Sounds too good to be true. And as Warren Buffett and many others have said, if it sounds too good to be true, it is too good. And the reason for that is you have to be defining the definition of what's an independent contractor versus a W-2 employee. And these independent contractors under tax law, under the IRS's watchful eye, are specific types of people. You don't have control. They don't have to work a certain number of hours. They can stop working anytime they want. You can't summarily fire them like you do an employee, although you can let them go. Usually you're going to have some kind of contract with an independent contractor. So in the interest of trying to save the payroll tax burden by saying, let's go with independent contractors, you need to be careful. If the person's working full time, it's probably not an independent contractor. If you're telling the person what to do, when to do it, having a degree of control on the person, they're not an independent contractor. So you can't play that game. It's not that loose. And the IRS is really gung-ho about who's an independent contractor versus a W-2 employee, because if you escape this, you don't have the payroll tax burden. So the IRS is saying, well, that's not fair. If you're supposed to pay the payroll tax burden, let's get you to pay that, as opposed to hiding behind the independent contractor name and avoiding that tax. Multi-state tax issues, very quickly, because we want to get to business deductions. There is income tax in most states. Unbeknownst to most people, there is an income tax in the states. There are 5 or 6 states that don't have an income tax. Fine. If you're living there and you're doing business there, that's great. However, if you're like most startup companies today, you're doing business in multiple states. So it's not going to be where your office is, it's where you're doing business. And wherever you're doing business, if you're doing business in states that have an income tax, you will incur the income tax in that state. So one more time, it's not where you're located with your office. It's not where you incorporate or set up your limited liability company. That doesn't make a difference. It's where are you economically? And that's where you're going to have to pay tax. You'll divide it up. You won't, generally speaking, you won't pay tax twice. You'll divide it up between the places and the states that you're doing business in. But that's a consideration to realize that you're not going to necessarily escape income tax at the state level just because you're in Florida doing business. If you're in Florida doing business and you don't do business anywhere else, good for you. But in most cases today, companies are interstate. And the same thing with sales tax. If you sell from Florida to New York, you're going to have to pay New York sales tax. Now you collect it from your customers, so it's not your burden, but you got to collect it from the customers and pay the sales tax. Should you fail to collect it from your customers, then the New York State people, pardon me, the New York State people will come after you. And they will say, you owe the state sales tax. And you'll say, well, it's the customer who's supposed to pay. Yeah, you didn't collect it, so you got the problem. All right. We have enough time to run through what we call Schedule C deductions. We'll just say these are business income tax deductions. They apply to all the companies, pretty much all the entities that we're going to talk about, business tax deductions. This is what lowers tax. If we do a quick schematic of the income tax, we said it's based on the net. So what's the net? It's based on the gross minus deductible expenses, whatever they're allowed and whatever they total, get you to the net, and it's the net you pay the tax on. So it's real important to get the net as low as possible using legitimate business deductions. So let's go through just a list. You got car expenses, if you use your car for business. And by the way, before we get started on this, let's just go through one more basic concept of what's a deduction. A basic concept of what a deduction is it's needed, and this is not good tax language, my professors would be angry, but it's needed to run your business, to make income. If you can justify it as being an expense needed to make income, it's probably going to be an allowable business deduction. So therefore, following that theory, a car. I need my car to visit clients. I need my car to visit potential clients. I need my car to purchase things. The use of that car then becomes a business deduction. You can take it in one of the two ways, either a standard mileage rate by the amount of miles that you drive for business. So it would be called the business miles. That's one way. The other way, and the final months of 2022, the rate for the business mile is 62.5 cents per mile. So for every mile you drive, your deduction is 62.5 cents. It fluctuates based on the cost of maintaining a car. The IRS changes it every so often. You could also use the actual expense method on how much it costs to insure, maintain, take care of the gasoline with a car. You could take the actual expenses times the percentage of business miles. That's how it would work. It would be times the percentage of business miles of all those expenses, and you can take the actual. Generally speaking, the actual comes out to a little bit more, but I like the standard because it's the standard approach. It's a little less of an auditable issue when the IRS comes around. It's a little bit less, not tremendously less, but it makes it life a little bit easier. That's opposed to the actual expense. You cannot deduct mileage for commutes. So if you're going from your home to the office, that's not deductible. But once you get to the office, anything you do from that point on, which by the way, this is a great point to say, if your home is your office, so we'll say this is your home and it is your office. So every time you get in the car for business and you go someplace, that's deductible. It has to be for business, but from the home to any seeing clients, potential clients, picking supplies up, it would be deductible miles from that point on because your home is your office. But from the home to the office is a commute, that's not deductible. Oh boy. All I'm going to do is underline this 10 times. Well, maybe not 10 times. You must keep records contemporaneously on a weekly basis. Now you're allowed to keep a sample. You don't have to do it 12 months a year. No one knows exactly what a sample is, probably no less than 2 or 3 months, but you got to keep some kind of record to show the IRS what your business miles were and make the sample show reasonableness that this is what I've been using my car for. Depreciation purposes, we're going to talk about depreciation. I think we'll have some time for that. Cars could be, if you're doing actual, you could take some depreciation for the car. If you buy it, they're limited. However, and this is why I did the slide, just wanted to throw the bone out to anybody who's looking for a big tax deduction this year. If you buy a car that has a gross vehicular weight, and the dealers know what that is, of 6,000 pounds or more, so we'll go 6,000 pounds or more, you get a deduction, a potential deduction of the whole price of the car under what's known as bonus depreciation. This is a very, I wouldn't say a rare event in the business world, but rare event for entrepreneurs just starting off. But it's possible if you started this year and you're making good money, buying a BMW SUV, the large one, will qualify, and you can pay for that and get a deduction for about the whole price of that car, and that's a pretty good tax deduction. Not advertising BMWs. I'm not a dealer, but I think you get the idea. Depreciation. Now we're on to that topic. If you have business equipment or furniture, if you have assets that you must use in your business and they have a life of greater than 1 year, and that's the key. Anything that has a life of greater than 1 year, you can't deduct it when you buy it. However, you depreciate it over its useful life. So you lose the cost of it. you depreciate it over its useful life. If you buy, oh, let's say a garbage can for $10, that has a useful life greater than 10 years, but nobody bothers with that. You just deduct it when you buy it. But if you buy office equipment like a computer at $2,500, that has a useful life greater than 1 year, that you depreciate. You don't take a deduction for the whole thing in the year that you buy it. However, there is bonus depreciation that exists today, and that's and Section 179. So between Section 179, which an accountant will explain to you, and bonus depreciation in the year 2022, it's very likely that your assets that you're buying that have greater life than 1 year, it's very possible that you can deduct the whole thing 100% under today's tax law. This law, these two sections, bonus depreciation and Section 179, are designed for an economic with an economic slant. They were put into tax law with an economic slant to encourage what you're doing, what you're contemplating and doing, to encourage you to open your business, because, hey, you get to deduct all this expense in 1 year as opposed to the depreciation, which is the normal way you depreciate these greater than 1 year useful life assets. So that's the whole idea. It's an incentive. And along those lines, when Congress set up the bonus depreciation, what they thought of is they said, well, we only need this incentive for a certain number of years. So 2022 is the last year it's at 100%. And as you can see, under the current law, before it gets changed again, which is possible, it starts decreasing. It starts decreasing to the point of it becomes zero after 2026. Now, given the economy that we're having now, maybe Congress will see fit to extend the bonus depreciation to 100% for 2023. Stay tuned. Interest expense on loans is deductible if it's a business loan. Rent expense, of course, you need an office or you need to rent for supplies to be stored or inventory to be stored. Of course, it would be deductible. It's that theory of what do I need to make income? Travel expenses away from home is what we're talking about here. I need to go to Ontario. I need to go across seas. I need to go somewhere in the United States. Those expenses of doing it, if they are primarily for business, they become deductible. They're away from your tax home, and then the entire costs you incur are really deductible at that point. Meals or travel qualify 100% as long as it's not, and this is the new words in the tax code, lavish or extravagant. If you want to know what those mean in terms of dollars and cents, I have no idea, but we sort of know it when you see it. If you spend $1,000 a night at a hotel and there's the marketplace around it, is it $250 a night? Well, then I think you get an idea of what we're talking about. There is no strict, easy definition, no bright line test for what is lavish or extravagant. What is not deductible today, it'll become deductible again at the end of 2025, but is entertainment expenses. So entertainment expenses are not deductible today. They used to be. It'll come back, we hope, one day. But meals or travel qualify away from home. Insurance expense for your business, of course, it's deductible. If you're a dentist, you need insurance to practice. That's the only way you can make money as a dentist, following the theory of whatever I need to spend to be in business is deductible. This is an example of some of the insurances you might have. We don't need to spend a lot of time on this slide. Legal and professional fees, if you pay me, a lawyer, to help you with any of your business decisions, entity choices, they're deductible as well. Notice the smile. I like that. It's my, with all due respect, it's my way of saying to my clients when they sort of look at my bill and they say, it's that high? I say, well, it's deductible, and then I smile. All right, wages and salary, of course, I need employees to work in my business. That'll be deductible. Contract labor, if it really is an independent contractor, of course, it's deductible as well. If it's really an independent contractor and not an employee, then if it's really an employee, you have to clarify it or classify as an employee. Advertising and promotion, certainly. Businesses need to advertise, they need to promote, deductible. Home and office, this is the biggie. We have enough time. Home and office. A lot of entrepreneurs start from their basement or their attic or their third floor den. And you are doing business and you're using your home for the purposes of making money. That space is like the theory, it's needed in order to be in business. I need to have that space. I need to have the area to work. And so there is something to a home office deduction. Rather complex, but it works. Let's say you're self-employed. So the area of your home that is dedicated to your business will be deductible. Let's just talk about two of these bullets, or three. We'll go through three of them very quickly. The area, if it's used exclusively as your principal place of business, you don't rent any other office space, then you only need one of these bullets. Then so we can check. If you meet this, you got it. You have an home office deduction. So one more time, you only need to meet one of these bullets. So suppose you have an office that you're renting, and so your home is not the exclusive place. All right, then what happens? Look to bullet 2. If you're using it to meet with clients, the area that you're using in your home is meeting with clients, dealing with patients, dealing with customers, then you have a home office. So you can have another office, but you're using your home to also meet with clients. You can meet with clients in the office you rent, but you're also meeting clients in your home, then you have a home office. And finally, if you have like a separate structure attached to your house, it could be attached but separate from the house, that automatically can be a home office. How to calculate the home office deduction? There's two methods. One's going to be, it's like the car. There's a simplified sort of by the square footage as opposed to by the mileage. That's what the simplified is. Take how much square foot for your exclusive use in your home for your office, multiply it times $5, and that's your deduction. That's one way. The other way is the actual expenses. This is the simplified method, square feet, multiply it by $5. Then the other way is the actual expenditures, and you'll take it, and you'll take the actual expenditures as a percentage of the house, of the home, and you can deduct your expenses of the utilities for the house by that percentage, of the insurance of the house by that percentage, you name it. Usually actual expenses for the home office deduction come out more than the simplified method, but you will probably want an accountant to be doing that for you. Home office, what if you're an S corporation or an LLC? How do you take the home office? If you're an LLC, I'm going to test your minds. I'm not going to ask you for the answer, but I'm going to test your mind, see if you follow this. If you're an LLC and you're the only owner, what did we say that is? A DRE, disregarded entity. That means you are a sole proprietorship back here, and these methods apply. But what if you are a LLC with more than one owner, or, so we'll say, this slide should say the following: an LLC with more than one owner, or an S corporation. How do you get a home office deduction there? Because what we spoke about just a second ago with home office deduction applies to sole proprietorships. So you can still get a home office deduction if you're an S corporation or an LLC with more than one owner. You're just going to do it this way. You're going to have an accountable plan. The accountable plan will say to the LLC or the S corporation, guess what? This is how much I use my home for purposes of the business. I use my home exclusively for clients or exclusively for doing my work as the owner of this business. And therefore, business, you owe me. That's what it means by accountable plan. Business, you owe me for the costs of my home office. And that's the way you get a home office deduction at an S corporation or LLC level. So you'll outline which expenses are eligible: rent, utilities, insurance, maintenance, water, real estate taxes. You'll multiply it times the percentage of the house that you're using. You'll give that to the S corporation or the LLC. You'll say, this is the amount of money you owe me to reimburse me for the cost of using the house, and the company will give you a check. It'll give you a check as an employee to reimburse you for those costs. So you'll give the expense reports, submit them, and get paid back. Cut a check from the business, you get paid back. The business takes the deduction, yay, and you got your home office. Business meals, we're almost done. And then we can have a short Q&A. Business meals, 50% deducted most of the time. So if you take someone out to lunch or breakfast, If it's take me out, you can only deduct 50%. That's the rule. That's the game. And it's based, I don't know exactly what qualifying food means. I think it means food that is edible, and you get a 50% deduction. There are some exceptions. So one of the ways you can test a CPA that you're thinking of using is ask them what meals or what purchases of food for the business might be 100% deductible. And these are the two exceptions: 100% cost of providing meals to employees when working late, or picnics, the company picnic, company party, the holiday party. They're 100% deductible. Education expenses, of course, they qualify for educational credits, but if you're not in the range of getting an education credit, you can also deduct education expenses if they add value to your business, and they would be for a webinar like this. This would qualify. This doesn't qualify for an education credit because it's not a qualified institution, but it would qualify for the business deduction because you need the webinar to understand tax law to open your business. It improves your skills in your business. Maybe it's a seminar that goes to improve your skills as to whatever you're doing. Not subject to a education credit, but deductible from your net income of your business. Books, same thing, subscriptions. The transportation to and from the classes are deductible. The one thing that's the exception is if the education could start you in a new career. The IRS doesn't like that. So they generally would say if you were taking a law degree and you're not already a lawyer, you're getting a law degree, that would not be deductible. It's preparing you for a new career. Moving expenses are eliminated. So except if you're with the military, so there are no moving expenses now until 2026. Of course, telephone, internet. Yeah, I need a telephone. I need a mobile phone. That's deductible. Not a problem. We're almost finished. Retirement plans are beyond the scope, but I do want to emphasize that there are many retirement plans that you can set up for you and your employees that are deductible, that are great from a tax standpoint of what they can do for you. Of course, there's the Roth IRA, which is not, or the Roth deductions, which are not deductible at the time, but they also have tax benefits for retirement. Don't forget to look at those when you're an entrepreneur. And child and dependent care, beyond the scope of describing it, but for you and your employees, there is an incentive to allow you to work, to allow your employees to work by paying a certain amount for child or dependent care to a facility, or to do it in-house, and you get a tax break for doing it. On the theory that I got kids, how can I run my business if I don't have someone to help take care of them? Startup expenses is our last category, and then we'll be done. I'll wrap it up. Startup expenses are expenses that it's important to know the difference. Here's another way you can test that potential CPA you're talking to. Just ask about startup expenses. You can say, what about expenses before I open the doors to my business? And they should blurt out, well, they're going to be considered startup expenses, and they may not be deductible at the time you have the expense, but they may be deductible later on through like a depreciation. We can deduct them later. We can elect to deduct them later. So they don't come out with something like that, then you're in the wrong office. So startup expenses are before you start your business. The expenses are deductible when you're in business, but when you're not in your business and you're contemplating, you're thinking about it, you're trying to get set up, but you're not open for business, those expenses to produce income, they're not there to produce income. You don't have a business to produce income. Remember the theory? Expenses to produce income are deductible. Startups are, well, I'm hoping to produce income. I'm hoping to open the doors, but there's no guarantee I will. So they're considered, quote, not deductible, but they will be deductible later on. And that is a wrap of the slides, which I'm surprised I got through, but I'm happy I did. And I'll go take some questions for about 5 or 10 minutes. We'll see how long I can last from the audience.
Thank you so much, Sam. I know this is a lot. It's really hard to fit a lot of the the entire account in just 1 hour. So next week, same day, same time, Sam will be teaching session 2. It's still going to be hard to fit everything, but thank you so much for doing this for us, and thank you for sticking around for extra time. And for those who can't stick around for questions, please send them by email, or you can also watch the video when we post it to see how other questions were answered. So the first question is, could we discuss qualified small business stock, QSB yes in this session or another. Obviously not this session. I think you touched a
Yeah,
little bit on.
that's next week. I apologize for that, but that's next week because that's a biggie, but that's a special type of deduction. Yeah.
Yes. Next question is, what if Maryland LLC but operates overseas through hiring contractors 1099 from the U.S.?
So they're one more time with that question. They're hiring independent
Like,
contractors overseas.
yeah, so it looks like it's an Maryland LLC operates overseas through hiring contractors from the U.S. So I guess it's a Maryland company which is operating in somewhere else.
That's okay, but if they're a U.S. independent contractor, you will have to give them a 1099. You'll have to report that.
Okay, thank you. Next one is maybe a touch on what common expenses are not deductible.
What kinds of expenses are not deductible? That's a good question. The general answer to that is that the tax courts have relied on what's called the business judgment rule. And that is, if the owner thinks it's required to help produce income, they generally allow it as a business deduction. Now, entertainment is strictly not, as we said. 50% of the meals expense is strictly not, as we said. Lavish, extravagant expenses are not, as we said. So it's the world is at your fingertips pretty much if you can justify it from a business standpoint. We call that the business purpose. And if you got anything questionable, usually what we do is put in the file a business purpose so that we have a reason to explain to the IRS why we thought it was deductible.
Thank you. And one last question. Where is the actual box to check or to change in the structure of your company from LLC to S Corp? On your tax return each year or some other separate form?
That's really a great question, and time limited me from getting into the details, but there's a separate form. There's a specific form for that. And what you do is you file that form with the name of your business and you check the box that's appropriate based on what you want to do. And you send it in separate from your income tax return to the Internal Revenue Service. It's a very easy form, by the way. It's one page. Very easy.
And actually, one more question if you have time. As a single member LLC, does the expense for tax returns come from personal or business?
One more time.
As a single member LLC, does the expense for tax returns come from personal or business?
Oh, that's a great question. And we didn't get into a whole lot about record keeping, but if you're a sole proprietor for tax purposes, you really probably want to keep like a separate account, separate bank account that shows all your business expenses. But in theory, you don't need that. Let's just take a sole proprietor who has just one account for their personal and their business use. What you have to do is you go through your expenses, go through your checks, your disbursements, and you say, oh, this was business, put that as a business deduction. This was personal, don't put that as a business deduction. And so you could really do business as a sole proprietorship with one bank account. It's a little confusing. It's not so straightforward to show the Internal Revenue Service if they ask to see your business records, but it's perfectly legal because sole proprietorship is by definition the totality of the person.
Yeah, thank you so much. Thank you so much, Sam. This has been very educational, a lot of information. I posted the link to the next sessions, part 2 of the tax issues for startups. That's going to be next week. I posted the link in the chat. You can also find it on our website or just shoot me an email if you can't find it. I'll share it again. I'd like to thank Sam for spending time with us. This is fantastic. As you know, all of us speakers are volunteers, so this is a big time commitment for preparation, and we very much appreciate. Thank you so much, and we'll see you next week.
Thank you all. I'm looking forward to it. Thank you, Ella.
Thank you.
Bye-bye.